Hello, welcome back to my YouTube channel, Money Life Invest. Today I'm going to talk to you about how to invest as a millennial or any beginner. So first, before we get into how to invest, first of all, we want to understand what are the problems faced by investors, and then see what are the what are the recommendation by industry leading, investment advisors, right? And then finally, what are the resources out there which can help you to go about investing? So the first and foremost is this is the graph that shows annual working hours per worker across various countries. I've chosen mix between developed and developing countries. You can see anywhere between 1,500 hours to 2,500 hours. So if you roughly you take an average of it and then factor in the holidays and vacations used by the workers, it will be around like 1,800 hours. So if you take 1,800 hours and uh, and divide by 52 weeks, right? So it will be like roughly 34 hours, and then if you divide that by 5 days, it would be like around like 7 hours, right? So let's say 7 hours. So in average, any person spends almost like 7 hours in working, right? It can be construction work, or you're an IT professional working in an office setup, or you work in a service industry like restaurants, uh, whichever may be. So average person around the world spends almost like 7 hours in work, plus considering, let's say, like everyone needs at least 7 hours of sleep. So you spend 7 hours in sleeping, then you spend maybe like couple of hours in relaxing, watching TV, reading books, whatever maybe your hobbies are, right? And then you spend like maybe like 1 hour with your family, right? And then maybe like yeah, so that's pretty much. So you are left with how many hours then? So you're left with almost 7 hours. So I would think this 7 hours is generally a non-productive hour. Like, you either spend on, like, getting up ready, you're like sometimes you don't feel like you're not productive, right? Not every So 7 hours is unproductive time, I would say. So if you think about it, in average, anybody spends around like 17 hours across, from working to leisure to sleeping to spending time with family. So there isn't enough time for one to go about, reading about investing or understanding the various vehicles. So, like depending upon the country you live in, and you may you have, like, stocks, you have like mutual funds, you have bonds, you have fixed deposits, your CDs, or normal savings account, right? There are various investment vehicle out there, but the problem is it's very complicated. You have very various things, and you have limited time for at your perusal. Therefore, a lot of times people tend to take the easiest route, which is the savings account. But the unfortunate truth is the savings account interest rates are is less than the inflation rate, right, of any country out there, right? So what is happening is you're investing your money in a saving vehicle which is not even beating the inflation. Which is not good. So so now this is the the problem that is faced by normal investors, which can be millennial or like any normal investors, right? So what is a solution? How can they go about constructing their portfolio? So for that, I want to bring your attention to Mr. Eugene Farmer. So Eugene Farmer is father of modern finance. So this is an article by Think Advisor. They did an interview with him on September 2021. So where they ask few questions which are very much relevant to any investors, novice investors, because these are the questions that they will get in their mind. And Eugene Farmer himself is not like a no one. He's a 2013 Nobel laureate in economic sciences. So his answers would be more pertinent and then can be related to anyone out there. So therefore, let's see what he has to say. So just to give you a background, so he got, as I said, he got 2000, in 2013 Nobel, the 2013 Nobel laureate in economic sciences for his paper on efficient market hypothesis, and he's currently still a finance professor with University of Chicago Booth School of Business, and he's called father of modern finance. And just one example, the index fund rooted from his efficient market hypothesis, for which he got his Nobel laureate, right? 2013. So um, this this article goes through some of the questions they have put forth to him, and this is very this interview is very good because it tells you, it tells basically what is the investment vehicle that a beginner or a millennial or like a young person can take, can you invest in basically. So first they want to first they asked him about what is please briefly explain your efficient market hypothesis. It seems complicated. And Eugene Farmer says it isn't complicated. It's very simple hypothesis. Price reflect all available information. So basically, what he says is, let's say, um, uh, so right now this is S&P 500. This is United States, one of the United States largest index, and it is at 3,959.44. That's the points it's at level it's at. And what he says is this this point is already reflecting all the information that is happening in the market as of today. So it already reflects all those information. Basically it has already factored in, and that's what, and then this is the price that reflects those events and news basically. And they ask him, financial behaviorist takes a different viewpoint, essentially that price reflect a number of investor biases such as overconfidence. Have you modified your view? He says no. And then they ask about important question, what do you think of an active management? So before we get into this question and his answers, we need to understand what is active versus passive management, because this is the key. So because his answers will be on active versus passive. So in order for you to understand what is active and passive, once you understand it, it's very clear. Then you can relate yourself to this answer, and then you can take his answer for for how you can go about investing. So what is passive versus active? Passive and active portfolio management. So according to Investopedia, like an investor can take two strategies, two main strategies, investment strategies. So one is active portfolio management, the other one is passive portfolio management. So active portfolio management is focused on outperforming the market. So let's go back to our example of S&P 500. So S&P 500 is an index. So the active portfolio management objective is to outperform. So basically, let's say for example now, as I speak today, November 14th, the S&P 500 is down year to date by 17%. So the objective of active management is to outperform. So even if they give like 1%, they are outperforming the S&P 500. So so basically how they go about doing is, instead of mimicking the S&P 500, they will pick few stocks that they think will outperform the S&P 500, and then they will make the portfolio out of that. It can be 5 or it can be 10 stocks. It depends on the manager's discretions. So they pick those and then they hope that it will beat the index, right? That's active management. Whereas passive is nothing but, the word says passive. You basically mimic the index. So basically, let's say you will mimic the S&P 500 and hoping it will perform the same as what you see here, right? Like, so for example, if it is down 17.49% year to date, it will be the same for you. But the idea is, you're diversified. You're not picking a specific security. You rather make your life easier by diversifying enough, by mimicking the entire index, which constitute like 500 stocks. So you're more than diversified. Um, so these are the two strategies an investor can take, right? So now coming back to Mr. Eugene Farmer's interview, where they're asking him, what do you think of an active management? He says it doesn't pay. Managers don't generate returns, they just promise. Ken French is a former colleague, another colleague of, I mean, his colleague, and Mr. Farmer wrote a long paper on this 10 years ago, where they suggest active management doesn't pay except in very rare cases. So, so it is not to confuse anyone there, that like it doesn't mean that active management won't won't beat the index. There are fund managers out there who can do that, but they are very rare, as Eugene is suggesting. And the next question they ask is, in fact, you were quoted as saying that making investing decisions based on past performance is poor idea. Why? So they say, so basically, Eugene says, think about investment management. This is well established fact. Winners don't turn out to be winners over the next 5 years, and losers don't turn out to be losers over the next 5 years. And the outcomes are based on luck. So basically, what he's saying is, let's say you go about investing in Apple, right? Let's say like 1 year ago, 1 year ago. So let's say 1 year ago, right? So let's say, so if you think about it, so 1 year ago you thought, hey, okay, so let's say like this is like November, right? November 15th of last year, right? So for the purpose of seeing beyond 1 year, I just want to go here. So let's say this is November, right? November, let's say November 12th, right? So you saw that the market is keep on increasing, right? Like beyond. So let's say like even if you look at 2020 to 2021, the Apple stock was keep on rising, and then you start like, okay, let me buy in Apple stock. So I should be expecting similar performance, right? But guess what happened? It didn't have the same trajectory. Actually, it ended up losing money. See, if you think about it, it's down 1.15% year to date, right? So sorry, year to date. Year to date is like almost like, if you think about Jan 4, 2022 to now, it's almost down like 18%, but if you think about 1 year, it's almost down 1.15. So if you bought the same Apple stock like 2021, thinking that, oh, by from 2020 it was keep on going up, so I would be making more money going forward. But guess what? It is down like 1.15%, like as of November 14th, 2022. So that's what Eugene Farmer is saying. Basically, winners don't turn out to be winners over the next 5 years, and loser don't turn out to be a loser over the next 5 years. He's saying 5 years, but in general, if you think about it, you take a security and you look at the past performance like 1 year or so, and then think that, oh, it will do good. But hindsight, it usually, nobody knows. So, and then the converse is also true. Like, losers don't need to be a loser. They can become a good winner too. So the outcomes are based on luck, right? So, so the next question is, yet active management remains very popular among investors. Why is that? So he says, I don't know. I think, in my view, this is because when you go to a normal bank, right? Usually the institution try to sell these active management active funds because they can make more money out of it because it has more MERs, right? Compared to an index fund, right? So they want to make money, so they always go and sell to, people who don't know better, right? And then say, hey, go and invest in this, right? So that's why it remains popular, right? People don't want to, like banks or like the big banks, they don't want to go and invest. Hey, go and invest in index fund because index fund is MER is very low, point 0.5%, right? Like very, very low, right? They don't make any money, right? So they want to, of course, advertise the, their fund that has largest MER by which they can make money for their company, right? So then this is the basic and the fundamental question which we are trying to answer now. So they are asking Mr. Eugene Farmer, the 2013 Nobel laureate, what is a better way to invest then? Using index funds? His answer is yes. This is very important. So Mr. Eugene Farmer says, for any investor out there, it's you are like a millennial, you don't, or you are just a novice investor or you're a beginner. If you don't have enough time, don't worry. Just invest in index fund, which is the passive portfolio, right? Passive portfolio management, right? Which mimics the particular index, right? So you just basically invest in index fund because it is diversified, and then he says diversification is your buddy. You don't want to be undiversified. So the reason he's talking about this is because, as I said earlier, index fund. So if you think about, if you're active portfolio, you're buying individual securities. So you're just buying like 4 or 5 stocks or like 10, 20 stocks, right? You're not completely diversified. Whereas like if you buy S&P 500, for example, you're buying the index that constitute 500 stocks. So which is basically well diversified. So your risk is minimized. And then what he says, what should an investor be thinking about when investing their asset? They said like hold a diversified portfolio. So here the diversified portfolio can also constitute an active management where somebody can pick, actively some stocks from across the countries and then make it diversified. But that is that is often time consuming. It's not possible for regular investors like you and me, right, out there. So what is the best way? Just hold a diversified portfolio such as an index fund, right? S&P 500, and that's it, and forget it, and that forget about it. That's it, as simple as that. So, so summarize, Mr. Eugene Farmer says, father of modern finance says, for any regular investors or a novice investor who doesn't have a lot of time, it's better for you to go through passive portfolio management strategy and invest in your country specific indexes. So it can be like if you're in US, you can invest in Dow Jones or S&P 500 or Nasdaq or Russell, or if you're in Canada, you invest in TSX Composite Index. If you're in Europe, you invest in DAX or FTSE, many other such indexes. If you're in Asia, you can invest in Nikkei. If you're in Japan, right? Hang Seng, if you're in Hong Kong, if you're in India, you can invest in Sensex or Nifty 50 indexes. As simple as that. You just buy any of these index relevant to your country. You start with that. Now, I can even further diversify myself by not only just invest in the country that I live in, but I can also invest in other indexes of the world. So let's say, for example, I'm from India, I can buy a Nifty 50 index, and then I can buy Hang Seng index, Nikkei index, or an index that so basically I can buy Nifty 50 index and then all the world index fund. Of course, I'm not sure if there is one exists, if there is a fund like that exists, but you can always go and further diversify yourself. So you start with, but to make your life simple, you start with your country, right? You start with, let's say, like you're in India, you start with Nifty 50, right? And then you try to see then you build upon that portfolio and see what is do you want to even further diversify, or you want to go about picking some securities. It's up to you. But to begin with, normally a lot of people, due to lack of time, resources, where do you start? You start with an index fund specific to your country and go about investing. That's it. As simple as that. Now, the final question is, what are the resources out there? So there are two ways to invest in index funds, right? So there are two types basically. One is mutual fund, one is exchange trade fund. So the mutual fund, think about it, is usually you can buy these mutual funds in your banks, right? So if you bank, like you must be having a bank where you deposit your paychecks and whatnot, right? So that bank should also have a mutual fund, and that mutual fund will have one of these index funds, right? Like Nifty 50, if you want to invest. So you go to that bank and say, hey, I want to invest in Nifty 50 index. Can you tell me what are my options? I'm sure they should be having an option. So, for example, so this is a website that tracks all the different mutual funds in India, and you can see SBI is one of the bank, HDFC is one of the bank. Both has Nifty 50 fund, Nifty index fund, and Nifty 50 index fund. So depending upon if you're banking with this institutions, you can go there and ask them, hey, I want to invest there. That's one option, right? And coming back, or if you're saying, okay, I'm willing to spend maybe half an hour or like a few hours here and there, so then you can go about investing in exchange trade funds. So exchange trade funds are sold in a market. So for that, you need to have an brokerage account. So depending upon the country you live in, there will be brokerage accounts like hosted by various institutions. You just have to create an a brokerage account and then buy an exchange trade fund which mimics you know the index that you want to buy. So again, there are a lot of information out there. So similarly, you can go here, so similarly, like for example, let's pick uh, uh, Nifty Nifty 50 index ETF, right? So if you look at this, yeah. So for example, ETF.com. So what do they say? So they don't actually show any specific ETF. So for example, here, let's say, yeah. So there you go. So let's say coming back to the ETS, you open a brokerage account. So for example, you can open, if you're in India, you can open a um, this is one of the brokerage account in India, Zerodha. You basically sign up, you create an account, and then say, and then they already say buy Nifty, invest in India, right? So basically, you open an account, and then you will be given username and password, and then what you do is you can go and buy one of these ETFs, right? So there are many ETFs that tracks Nifty 50. So you can either go and buy SBI Nifty 50 or ICICI. So as you can see, these ETFs expense ratios are very, very low, right? Compared to an active mutual fund, they are usually low. So you're better off. So basically, you can either select, you can go to your financial institution, and then ask them for a mutual fund that mimics, Nifty 50 as an example, right? If you're in India, go and ask them, and then they will show you. Or you open um, uh, like a brokerage account, such as, like, Zerodha if you're in India, and then buy any of the ETFs that tracks the Nifty 50. As simple as that. Similarly, if you are in other parts of the world, you can go to, for example, if you're in Canada, you go to your bank, because you get your paychecks deposited there. You say, I want to open an mutual fund, basically an index fund. So this is an example of TD Bank in Canada, which shows various index funds. So starting from Canada index fund. So if you click on this, basically it says this fund, Canadian index fund, right? So basically, this fund will mimic uh, Canadian equity market, which is uh, which is which is TSX, right? Right. So you can invest in that, or you can invest in bond index, or you can, if you're interested in Europe, you can invest in that. As I said, like, you can either you can start with your country, and then you can further diversify by investing in other parts of the world. So these are the two options. So just to summarize, what are the resources? Basically, the resources, the index fund comes in two forms. One is mutual fund and exchange trade fund. So the easiest way is to go to the financial institution where you bank with, and ask them to open a mutual fund, basically the index fund. In a mutual fund, they will have an index fund specific to your country, right? And then you can buy that, or you can open a brokerage account, um, and then buy an exchange trade fund, again, which is mimicking the index. So these are the two different option. And like a novice investor, or like a millennial, or anyone who wants to get started can do, who doesn't have enough time, can do this. um, I believe that's the way you start, and then later on, then you progress into from from this simple strategy. And if you still want to spend time, then you can go about researching more and even further diversify, or you can pick some stocks. It's up to you. But to larger problem of people not having finding time and investing, the better option is to invest in index fund. Just go to your financial institution, talk to an advisor, and then buy some basic index fund that mimics your country. That's it. As Eugene said, that should be a good strategy for you to, hold it forever. That concludes today's video. Thanks a lot for watching my video. If you liked this video, please click that like button, subscribe to my channel, and if you want me to do more video, please comment on my video and say anything in specific that you want me to make video. I will do that next time. So happy investing. Thanks a lot for watching. See you next time.